100,000 euros in VWCE as a portfolio or 80,000 in IWDA with 20,000 EMIM? What difference will 25 years make, and why would you choose one above the other? In this video we're going to compare them. So before we can compare, we first have to understand what they are. So we'll start off with the VWCE. The VWCE is the closest thing us Europeans have to buying the entire world with a single click. Now it has 3,700 companies spread over 49 countries, which is quite insane if you ask me. And it has a fee of 0.19%. Now those 3,700 companies and the markets they are in are developed and new and emerging. So it's mixed. So that's the VWCE. Now let's see at the IWDA. This one has 1450 companies within it, spread across 26 countries. Now these companies are only developed countries, so no emergings like China, India or whatsoever. This means that the IWDA is less volatile. Now, why would you then buy the EMIM? Well, that is for the emerging markets that you're missing within the IWDA. And this is where you put the 20%. So this is obviously more volatile. And with that combination, you almost have the exact stocks as the VWCE. That still begs the question, why choose any of them? Why not just go for the VWCE? Because it's a single one and it's a lot easier. Well, that's true. The VWCE is easier because it's only one stock and you don't have to think about it, you just invest. But the other option, the split, gives you more control. Because the new emerging markets are more volatile, they are prone to change. So with the split, you have the option to allocate less funds in times where they are not performing well and add more funds in times that they are performing well. With the VWCE, you don't have any control over it and you just put money in and have to wait and see how they fare. Now let's see what this difference could make if you invest for 25 years in either one of them. Now if you invest, since the VWCE has a fee of 0.90% and the combination of the split also has 0.9%, this means that at a growth rate of 7%, both end up after 25 years with no extra money invested at around 580,000 euros. Now, if you add a dollar cost average automated investment at 500 a month, then you will get close to 888,000 euros. So again, pretty similar. But the difference is this is based on a 7% annual return. Now with the split, which means you have more control, this profit can of course go above the average of 7% if you perform well. But if you make mistakes due to you having control and choosing wrongly, this means that your annual returns can be a lot lower. So if you're new and you want the safe option, go for the VWCE. It's easy, just put your money in and you don't have to think about it. But if you're more experienced and you want more control, then go for the split. That means you have more control over your money and you can increase your profits if you're doing it well. So this is the difference between the VWCE and the IWDA split. Now, if you like these kinds of videos, make sure to subscribe and like so you never miss out on a new video. Thanks for watching.